Work at home.
Yeah, right.
That ends at 3 o'clock.
Yeah, that's cool.
Yeah.
You're your own boss. I love it.
Yeah.
Got a lot of stuff.
Gotta
Gotta go
go.
tape it. We got some podcasts live. Guys. Audit, save it up.
I'll second. Thank you.
Good morning. I'd like to welcome everybody to the Audit and Finance Committee meeting of the CCIDA, CREDC and CRC for the BWV building at 201 West Third Street, Jamestown, New York. It's 8:05, also streaming live via YouTube and Zoom. It's March the 19th. We'll start with roll call. Gary Henry's here. Sagan Sheffield Smith.
Here.
Thank you. Should have already received the minutes and had a chance to review those. Do we have a motion to approve the minutes?
So moved.
I'll second it. All in favor, say aye.
Aye.
Aye. Minutes have been approved. And we'll move right into new business, discussing the audit of the 2023 financials.
Thank you very much. What we have in front of you is a copy of the draft audit report, and for the most part, it's complete. There's a couple yellow highlights that we're just waiting on some information to complete. And then we also want to talk a little bit about the reserves that we have on the loans, which I think is usually during this meeting that we talk through that a little bit. Then we have a management letter comment and also a governance letter that we'll go through. So why don't we start with the independent audit report, and Justin's going to kind of walk us through it, and I'll certainly chime in as well.
So if you want to go to page 1 of the independent auditors report, we'll talk about the opinion. This is a clean opinion, the large document. Mine's just not stapled.
This one right here.
The one right in front of you. This,
Oh, this.
Yep.
page 1 of this report, the auditor's opinion, the whole point of us coming out here is to provide its opinion that they're in accordance with GAAP. So that's obviously a clean audit opinion, no modified wording. So that's, good job, Rich and Kayla, because that's the whole goal of us coming out, is really providing that opinion.
Thank you.
Pages 3 through, I think it is 7, are what's called the management discussion analysis. We won't go through that in detail. There is one section that we have a highlight, though, on page 7 that we often get from you guys. That's really a bullet point. We're talking about future items, things coming down the pike that you'd like to be mentioned in here. So that is one thing I wanted to kind of point out. Maybe you guys could look at that, try to come up with something to add to that. I think you'd.
Well, I just read it and it looks pretty good.
Yeah.
I mean, you nailed it.
Yeah.
I mean,
I was
Yeah, I
thinking it
think
was
the
pretty
song-
applicable.
Song remains the same there, basically.
Yeah.
I think,
I mean, we could give more details, but,
Yeah.
you
Okay.
know,
Seems like.
yeah, I mean, it's, yeah.
Okay.
the focus.
Yep.
Okay, so then we'll go to page 8 and start talking about numbers. All right. Yeah.
Oh,
So this is your balance sheet, your consolidated balance sheet. It shows, each of the funds, what's under the CCIDA umbrella, what's under the CREDC umbrella. Balance sheet wise, big thing to talk about. One, if you were to compare this to last year, if you were to pull out last year's financials and look at it, the first thing is property and equipment line is down quite a bit. Well, the Talcott Street building, that is the big driver. It actually pops up in a couple spots here, the sale of that and then the payment of that debt. So that's on the CCIDA's books itself. Other than that, the other balances pretty consistent. We do have, our current notes receivable there. We have our cash and cash equivalents, about 11 million. Other assets, so the big change here, and we'll talk about it when we get to that one sheet that we have to talk about the loans, but that allowance for uncollectible notes receivable is kind of always a talking point here. Do you want to go over that now and talk about it? So you can see the levels we have it right there in parentheses. About 1.8 for LTAC, 1.8 for EDA cares, and we have a supplemental sheet, the landscape one we provided. That kind of breaks out, what the what the reserves were, what the outstanding loan balances are. And then what the Federal Reserve tool, that's what that ELE tool percentage came back with. So that's the levels that like this Federal Reserve document that I, utilized to come up with the new kind of allowance method that was called CECL required. So.
Talk through like what the inputs, some of the inputs.
Yeah, so I had to get 10 years historical average write-offs for each of the loan portfolios, each fund. So I went back in time and went through 10 years of financials and pulled out your write-offs, the actual write-offs, not the change in allowance, but the write-offs
Okay.
for each of the funds that had loan portfolios, and then applied it along with the average balances to those loan portfolios. And then also I had to get every single loan you had and all the interest rates and populate this large document and put in, there was a lot of data input to it, but once it worked, they created quite a nice document for us because I clicked a button and it calculated what's like, I think they call it the warm method of allowance. I'm not sure what that weighted average something. And that's what came out with these 19%, 17%, 13%.
Sounds reasonable.
So
Yeah.
it's like, that's the average
Yeah.
over time, over a 10-year
Yeah.
period, which is a pretty long period. Now, obviously, the EDA CARES is relatively new,
Yeah,
so that hasn't been around very long, but certainly the LTAC has. So the LTAC was 10 years of data of what our history, in some years we've written off nothing, and other years we had a big write-off.
Yeah.
So it's over time and it's kind of the weighted average, as Justin mentioned.
yeah. So that ELE tool came out with 1.7 for LTAC. We have you were at 1.8. So we kind of felt pretty good with that. We actually rounded them up and got them to 20% for the LTAC, the CRLF and the EDA CARES. And we brought up the EDA CARES, even though that ELD tool came out with 13%. Part of it is there's just not as much history as Dave mentioned. So it's a little bit lower. So we, bumped that up to 20% as well, figuring it probably will have similar experience as the LTAC fund. And then the CREDC, that one is only at 5%, but really that is, that's kind of hard. You have $1.2 million of loans outstanding, but more than half of that are deferred, that you have a deferred amount offsetting it already. So it's almost like you've reserved against it already 100%.
Those are the ones that'll be forgiven.
Yeah.
So it's.
You don't recognize.
As long as they comply with that.
Yeah.
Exactly.
So that's why that is only at 5.
Yep.
So that's where we put you in the financials. We made some slight adjustments. I think the EDA CARES got a little bit more of an adjustment than the other funds, but we took you up to those levels and rounded them out.
Now can you save all that data and just keep compounding each year?
Yeah, I think I could, it's all in there. So I think all I'll need to know is what loans are either forgiven or paid off, and then to take them off, and then I'll need new loans.
Right, awesome.
Justin, you sent me the tool.
Yep.
I didn't look at it. I just didn't have time, but did you send me the one that you populated or just the blank?
The one I populated. So the one that's got all your data.
I'll share
Yeah.
that.
That's great.
And it actually calculates down to the loan level, like what we anticipate your loan one from the LTAC is going to be the write-offs on that over time, based on the percentage historically written off on each loan. Now, it's not, you don't need that much detail really, because the majority of your loans are gonna get paid. It's kind of assigning that percentage to all the loans in the bucket, when really, the more likely situation is you have one bad apple that kind of brings up that balance, but
Is that something I could populate for you in future years?
yeah.
Absolutely.
Add the.
Absolutely.
Awesome.
Yep. That would be wonderful.
Save me time from doing the spreadsheet, send it to you and then you input.
Yep.
And what was the amount on our books? I'm just curious.
Yeah, so I think your books were this middle column,
The 3,545,000.
the 3,545,000. Okay, and that's typically how in prior years,
Right.
the reserve was kind of set. It was at 15% plus any loans that we thought were troubled
Mhm.
were reserved against it as well. So it was a combination of both.
Mhm.
And so really, for the most part, it looks like a pretty, actually, was that their number? Do you know that 1.4?
No, I
No.
think I think this is after I adjusted.
Yeah,
Okay,
I think mine's a little higher.
yours
Yeah,
was higher.
yours was
Yeah.
higher.
Yours was higher. Yours was actually higher for the LTEC and lower for the EDA.
Right.
But this is like historically
Right.
how it was calculated in the past.
Yep, got it.
And so, literally the LTEC fund in 2023, like every single loan was pretty much current with maybe one exception.
That was that.
And even,
That was that little emergency working.
yeah,
Yeah.
yeah. So, you could argue like at the end of the year, like everybody was paying for the LTAC. But again, I think history shows us there's some that are gonna be bad. And so seems like it's reasonable to use, either 19 or 20%. The EDA loans, again, they're new. And you could say, the history is showing 13%. If we use 15 like we did last year, we'd only be at the 1.3. But there are a couple loans there that were, a little bit iffy,
And we don't have a large sample size, so it's better to be conservative.
Right, I agree.
seems like it.
Yeah, and the one I got an appraisal.
Mhm.
And the forced liquidation value is 3 times what my loan and Steto's loan.
Wow.
So I was very
Yeah,
pleased with that.
That's awesome.
Mark and I were a
Yeah.
little skeptical of that.
I don't know.
That was forced liquidation.
Yeah.
It was a lot higher the other way,
You're
but,
right.
but we're gonna find out. So
Yeah. So what do you think? Are you comfortable using the
I think that
20%?
makes a lot of sense. Yeah,
Absolutely.
absolutely.
Kind of mirrors the tool.
I'd rather be
Got it
more
back.
conservative
Right.
than not.
Yes.
Sure. Yep.
Okay.
No problem.
Okay.
All right, so now we'll go back to the financials. So then the other asset item to probably talk about is this real property held for resale along the bottom. That's where the North County purchases are sitting. So, as you purchase and add those properties with the intent to sell, that line is gonna grow each year.
That includes all the phase one
All the phase
parcels
one,
that
about
were
1.8
purchased.
million, yeah,
before the end of last year.
yep,
Okay.
correct.
That makes sense.
Okay, current liabilities, the big thing to talk about here is that middle line, the unearned revenue, and we have a really nice footnote on it that talks about each kind of program you have, and what you have unearned. But you have about $5.8 million in the IDA right now, that's unearned revenue. The majority of it's 2 programs right now, it's the North County
Mhm.
site that's got about 3 million of it. And then I believe the broadband is a little over 5, yeah. So that's what's making up that balance. And then you can, on the credit column to the far right, $1.8 million, that's a lot of smaller grants for the most part.
Mhm.
I think probably the largest one at this point is the Ralph Wilson.
Mhm.
Yes.
There's some money in there. So. Okay, let's go to page 9. We'll talk about.
Just a couple items to mention. So obviously your cash levels at the end of December, particularly in IDA, were significant. And that's really because, again, we received a lot of the funds from the county that were advances and we just haven't spent the money yet.
Mhm.
So it's cash and unearned revenue. And then as Justin mentioned, just like the property and equipment went down, your long-term debt went down because there was a loan related to the Telcap property that basically was forgiven.
Mhm.
Okay.
Mhm.
We're still, the county provided something, but it was more just like a cash receipt. I'd like to get something a little more
Good luck.
definitive that says, that they've forgiven the loan. The loan was like $2 million.
The bond, yeah.
The bond.
Bond, they paid $1 million down
Yeah.
and then we gave them 1.5.
You
I'm gonna email Kitty and copy you. That's the only way.
Yeah, even if we have
Yeah.
to draft the language, I mean, I don't
Yeah.
know.
Yeah.
Just have her sign it, yeah.
Yeah.
That would be fine.
Anything from Kitty,
And then remember last year, we had a lot of discussion about the new lease standard, which required us to compile the rental of primarily this office space and cost it out and say, okay, how much do we have remaining on the leases and capitalize that as an asset and then also show that as liability. So you'll see, included in our liabilities, there's a lease liability and that's related to the space primarily. And it's also included in your property, equipment and right to use assets. That's probably the predominant asset that.
Yeah, that's, you about 700,000 of the million asset you have in the IDA is really the lease related to this space. And a smaller portion to the other space you have. Page 9. So if you want to look each of the funds, you'll see the change here for economic development service agreements. So for the audit committee's perspective, if you were to look at last year's, some of that was on the grant income line. And those are so we created this new line called economic development service agreements. So the way we had been treating the ARPA monies coming from the county was really as a grant in the past. And after further discussion with it, they're not viewing it as a pass-through grant. They're viewing it as a contract service agreement. So that changes the single audit, the federal audit we have to do for you guys some, because it no longer is a requirement for you guys. But then it also probably, really affect how we report it here. It probably isn't, pertinent to call it grant income. So we moved it down a line.
That makes sense.
Yeah, it does.
So we have the 2.4 there, and that's, a lot of it is the North County, you got to recognize 1.8 of the revenue when you bought that land. So that's what's really driving that. You can see over on the other side, CREDC, you spend a lot of it, and a lot of that is grant income. So there's a lot of the Ralph Wilson, a lot of the smaller grants, they do kind of add up over time. Yeah.
Exactly.
Overall, your expenditures, if you want to look at like the excess revenue over expenditures, sources, pass-throughs, you made 1.1 million or $6 million in the IDA. Now that is, a little bit misleading because you have an asset sitting on the books now. So instead of, a normal grant, you have income and expense. Here you have income and an asset. So it's not hitting your income statement yet. So, that's what's driving that revenue. We've got to recognize the revenue, but we don't really have an expense offsetting it that's hitting our books yet. It's in a balance sheet item.
So Dave and Justin, in 3 years.
Yep.
And Waltz is a big box, buys that whole thing, pays the IDA a lot of money. How do we account for that?
Yeah.
How does Kayla?
If the amount equals what you put into it, it's just gonna be debit cash and credit the land held for resale, and it'll have no effect on your income statement. If it's more than what you put into it, then
It won't be.
some of it will flow. Yeah, it probably won't be. Some of it would flow through here, but if it's equivalent to what you paid for it, that's what's sitting in the land held for resale. So it'll just be a balance sheet wash, cash.
So we no longer feel that any excess or any cash that we would receive, the idea would be able to keep and reinvest in other property, correct? We don't have to turn that back to the county.
Well, that's the question. Yeah, I'm not sure.
Yeah, so I mean, there was never any discussion about paying it back.
No.
Yeah.
Nor in the
What
agreement.
what we want to do is keep that in a separate account and use it to keep buying more land and creating more industrial parks
Exactly.
dedicated.
Yeah. Yeah, and I think,
Because by the way, this isn't one and done,
right,
we
it's
gotta
gonna
keep doing
continue
this.
to do it.
Yep.
Yeah, one of the items, we can talk about this now. So we've got a management letter, and as Justin mentioned, this funding that ultimately is coming to the IDA is through federal money that was received by the county. And ultimately, the county, I think the money probably originated at the federal government, went to the state, and then went to the county. In the federal world, there's what's called like a pass-through entity, and there's also a subrecipient, and there's also a contractor. A pass-through entity is an entity that gets a federal award and passes it through to what's called a subrecipient.
That was in our county,
That would be New York
State.
State.
the county.
Yeah, New York State is for sure a pass-through entity because they're getting the federal money originally and they're passing it through the county. The state has still some responsibilities with respect to that federal money. They have to, what's called monitor the subrecipient. Okay, they have to do a risk assessment on whether or not they're going to comply with laws and regulations. They might do some follow-up, potential, send me some information so we can monitor it. They would look at the county's audit to see if there were any findings with respect to that money. And that's part of the monitoring. Okay. Well, there can be more than just one pass-through. It could go to multiple folks. But ultimately, the subrecipient is the one that's responsible for ensuring that the grant requirements are being met. They're the ones responsible. The pass-through entity monitors it, but ultimately the subrecipient is required to follow the letter of the law with regards to the federal money. And so the discussion we had with the county was, how are you treating the IDA? Are you treating the IDA as a contractor, which doesn't pass through the requirements, or are you treating them as a subrecipient? And ultimately, the discussion is we made the determination, the county, that we're treating the IDA as a contractor, not a subrecipient, which ultimately means the laws and regulations are still with the county, is prescribed by the federal government. The IDA still has to follow the contract, the agreement, but as far as like the federal guidelines, that still lies with the county. Okay, so that's important for how it gets treated on the financial statements. What our management letter kind of says is, there are some stipulations with any federal grant on, how you can spend it, if you, for instance, earn interest on funds, does it have to go back to the federal government or not? If you buy property or if you buy equipment and then you sell it, what happens to that? And so our comment is, even though, we're designated as a contractor, because there is a relationship between the IDA and the county, I think it'd be prudent for the two parties just to, make sure, like, is there any potential issues? Like, if we do sell this property and recoup some dollars, are we allowed to keep it? Or does they have to go up to the federal government? And those are kind of the discussions that we're just kind of saying it'd be prudent to do. Because ultimately, if, 5 years from now, the federal government comes in and says, gee, no, that we sold that property, that needs to go back to the federal government. Yeah, that's more of the county's problem. But, would it trickle down to the IDA and something? And so we're just kind of leaving it up there now.
So Dave, every state
ahead.
got an allocation of
Yep.
ARPA money.
Yep.
New York State, every county, every city.
Yeah.
Was it statistical metropolitan areas, or I don't know how they did it, but
Yeah.
they had a lot of contracts or whatever. How do other states do it? Do you know, did it?
Pretty similar.
Okay.
I think there wasn't much. I think everybody did a little bit different, would be my guess, just like all this federal money. It was really, ultimately, whoever got the money, like, they decided what was the most need in our area, and that was the beauty of it, really. And I think that was the intention of it.
Well, it was kind of like the CARES money. I mean, they called us and said, can you spend this? Yes. Then they said, spend it as fast as you can.
Yeah, exactly.
That was the
Yeah,
whole.
and some of the money, actually, the majority of the money, at least that's coming to the IDA, was through this revenue loss. And so the county, some of that funding had a little less restrictions on it. An example is under normal courses, like federal interest does have to go back to the federal government. It's like right in the regs.
Yeah.
There was an exception for some of this ARPA funds that basically said, we're going to exclude that portion of the federal guidelines because this was revenue loss type stuff. And so maybe the same applies for, if we sell property, but those are kind of things we're kind of saying, hey, let's make sure we're kind of reviewing and understanding so that something doesn't come back 5 years from now and bite us.
How would that look? Would that be another agreement with the county or just a letter of explanation or just?
I just think,
Conversation.
yeah, just a conversation and
Okay.
a review. And if you think there are items where, it might be not necessarily black and white and gray, you might ultimately, go to the program administrator at the federal government, say, hey, this is our plan. We just want to make sure, what we're thinking is going to work going forward and get their buy-off on it.
Well, I can tell you, and I was involved in, obviously, the conversations about the ARPA from early on. There was there's no thought that this money needs to get
Yeah,
paid back.
exactly.
Zero thought of that. So, and I feel pretty good about that, but
Yeah.
we'll have that conversation just to make
It's just,
sure, so we can put it to rest.
yep. Yes, I think it'd be worthwhile.
Who and when ultimately makes that decision?
Well, it would be in the regs, right?
Yeah, the regs are the ones that
Yeah.
dictate it.
Okay, right?
And then, who would require it? I mean, it would be us to follow their regs. Certainly if we didn't follow their regs, the federal government is gonna eventually do audits
Oh,
of
sure.
these types of funds and so then they, potentially doesn't say it's absolutely gonna happen, but there's a chance that they could come in and review it and say, geez,
Hey,
yeah.
back.
Yeah.
Understood.
Thank you.
So then, talking about the other funds and where they kind of ended up. The revolving loan fund lost about $30,000, but if you really look, there's that bad debt expense recovery line. That's really what's driving that loss. That's an expense adjusting that reserve up. LTEC fund made about 157,000. That's really just interest. We didn't adjust that reserve too much. And it's really just the interest being earned on the loans. EDA cares lost about 300,000. And again, you can go up to that bad debt expense line and see what's driving that. If it wasn't for adjusting the bad debt expense, you would have made about 140. And similarly in the CREDC, you made 115. The 82,000 of it is really, it's a bad debt recovery because we adjusted that bad debt expense down. So it's adding to your net income. So without that, you would have made about 30,000, which is what you'd expect. Those loans or those programs really, for the most part, are money in, money out. So you don't expect to make a lot of money there. So then talking about this little group called other financing sources, Dave mentioned the sale of the building and then the loan forgiveness. So we have that broken out, what you actually lost on the sale of the building, which was about 118,000, then what you gained by being able to write off that debt related to it. So you lost 118, gained 978. So a net positive for the IDA of 860,000.
Yeah, so basically included in the property and equipment was a cost that was more than your proceeds. So that was a loss. And the loan balance plus, in addition to the loan, because the loan agreement had wording that there was interest to be accrued on it, there was also interest that had accumulated on the loan that was also recorded as a forgiveness. So again, the total amount that we remitted to the county were the proceeds were less than the original loan balance plus the accrued interest, and that totaled 978,000 is a forgiveness.
The accrued interest was $320 some thousand.
Yeah, exactly.
Okay.
It was like 2.3
Right.
total.
And the county never recognized
Yeah.
on their balance sheet any revenue. They they didn't think they were ever gonna get it, so they never even recorded. So the highest it ever was $1 million, 2 million.
Mhm.
Their accounts receivable, and then they wrote off $1 million a few years ago. Mark was involved with that.
Right.
And then, so again, they were pretty happy when they got 1.34.
Yep.
Okay, but we'll get that letter, so Kitty.
Okay. Then we won't talk about,
Can I ask one question?
yeah, go ahead.
The prior period adjustment in critic?
Okay, yeah, that is so there was revenue that was recognized in the prior year that really should have been deferred.
Okay,
So one of the programs, we recognized $56,000 of revenue in that program, but then Kayla and Nate were reviewing it. They said, no, we should have deferred that. We're spending that now. So they pulled it out of equity, put it into a deferral.
gotcha. Thank you.
Mhm.
We'll go over the cash flow, but this kind of shows the ins and outs. It can be kind of complicated to follow along at times, but it's a good summary of where your cash came from and what you spent your cash on, but.
So ultimately, the sale of the Talcott was kind of an in and out, really ultimately didn't, it affected our cash right when we got it, but then we distributed it to the county. So it really had no overall impact on our total cash balance. Again, the biggest thing is the fact that we got a lot of money for the economic development service agreements, most of which is deferred at the end of the year.
So then pages,
Hated this sheet.
This is,
I hated.
I'll tell you, your cash flow is, there's complexity. It's not an easy cash flow, I can tell you that.
Yeah, I'm sure. I always hated this one. What did it used to be called, Dave? Before this was- It wasn't cash flow, it was something else. It was a little
It may be
easier, but
something,
anyway.
yeah.
pages 11 and 12, these are your fiduciary accounts. So what it really is the retirement accounts you hold for your employees. So that you'll see the one column's highlighted. We just haven't gotten the information from Nationwide yet.
I'll call Fetchman.
Thank you.
You don't seem to want to respond to
Yep.
emails.
Okay, so then we'll go to footnotes. Let's go to page 15, actually. Many of the footnotes for the start there are kind of similar to prior years, but page 15, you have the real property held for resale. That's where the North County items are being held. So you can see there you added 1.8. To get to your total property held for resale balance of 2.7. It's quite the addition there. If you want to go to the next page, page 4, you have the property, plant and equipment footnote. You can see there the effect of Talcott and, getting rid of that asset or selling off that asset and how that, went to a zero this year. Then there are actually some other equipment that went with the building that had been recorded there with that as well. That's what the 59,000 is. Page 17, as I mentioned earlier, we have a nice footnote where we kind of have a narrative format of each of your unearned revenues, each of your programs where you haven't spent all the money yet. The one thing Dave and I kind of discussed is the idea of possibly turning this into a chart instead of a page and a half of paragraphs. Just because you just have so much more activity than you used to. When you had 2 or 3 of them, it kind of made sense to just have a couple blurbs on it. But now that you've gotten to the point where you have, close to 20, it might make sense to have more of a chart to follow along. But that's really ultimately, these are your financials. So whichever.
I like the notes, I'll be honest with you.
Okay.
It's very helpful. For me, Kayla probably understands it a little
I
bit.
love spreadsheets.
Yeah.
I do. No, this is
Okay.
my mama's spreadsheet. More complicated,
Yeah.
but this is helpful. I
Yeah,
think
so-
helpful for the board too, Gary. I'll be honest with you. I know, right?
So if any of the programs, you'll see where the monies came from, what it's meant to be spent for, how much you spent in the current year and how much is left in that program. Denoted in each of those.
And I think it's helpful to have the narrative because we use this in some of our reports to the state.
Mhm.
And they're not big chart people. They want,
No.
they want us to see it. So that's just helpful when we do our reporting as well.
Uh-huh.
I wonder if you shouldn't label that column as the numbers, that the balance, that's what was paid on page
Oh,
19.
page 19, starting with the loans, yeah. So these are the notes receivable, so these are the balance owed, yeah,
Just,
yeah, maybe add that.
Yeah.
But so these are, we have each of your loan portfolios, your revolving loan, your LTAC trust fund, your EDA cares. And what each loan is at, where the balance, the current monthly payment should be, or if it's some other payment schedule, most of yours are monthly, and what the interest rate is and maturity date. So every single loan in your portfolio is in here.
incredible amount of work. That's work.
The one thing on page 20, and I can't remember if I asked you for this, we usually disclose the loans committed that haven't been paid out. So I think EDA cares, there are none because, you've spent all that money so far. So there's nothing coming down the pike, but LTAC, I think there were 2 loans I saw approved later in the year that hadn't been released yet. Yeah.
Makes sense.
Okay. Page 10 or 23, note 10, your long-term debt, you'll see here the big change if you compare it to last year, the $2 million it's gone for the Talcott. And it talks about the interest paid on your debt. So currently only 44 again. As Dave mentioned, the right of use asset and the liability, that's kind of a nice footnote to show what those numbers he's talking about are. And the present value of the lease is $796,000, but the asset that's, Saturday gets that is pretty similarly. It's I think within $8,000, the 2 items.
What is the 2029 and thereafter? The 320.
So it goes through 2031, so that's 3 years of payments.
Okay.
The final 3 years.
Gotcha.
Note 12, the work this year, I know, Kayla does a lot of work on those pass-through transactions for the pilots, but, that's an important footnote. You guys, trust is put in you to manage that program. So I think that's an important footnote. But, no issues this year. I think it's been 3 or 4 years since we reported on that.
It's interesting as we've had some other legal people in to look at some of the things we do, our policies and procedures. As far as they know, we're the only county that collects and disperses pilot payments, the only IDA.
Yeah.
The other IDAs will make the deal and then they'll take the pilot to the assessor and hand it to them
Mhm.
and to the taxing jurisdiction there. You go figure it out, you go collect. I'm sure. But, in my 20 years, the reason it happened was that it was just so hard. The county just never quite got a handle on it and they just pushed it back to the IDA. But it is a tremendous amount of work. And I agree, Kayla's done a great job with that. I mean, it's complicated, very complicated. And
COVID was rough. That was.
Yeah, I think that was the year.
yeah, and if you have a tax rate of 17.01378 and you put in 0.0735, I mean, that's $60, then you might get written up for that. But Kayla has a great relationship with a lot of the assessors and there's a lot of them. And,
Yeah.
so it's, she's done a great job. Good job, Kayla.
Also on page 24, you'll notice the yellow highlight. That's the nationwide again. So once we get that information, we can put that in. Note 17 and 18, he's gotten a little smaller the last couple of years. When I first took the job from Kyle, I think years ago, there you had like 7 wind farms. It was 6 of them. There's a lot of them. You're down to just one last one to pay, Casadega. So. And then you have the other projects in the future payments broken out there on pages 24 and 25.
And all the projects through now have basically, we recognized the income when the project had commenced. And there was shovels in the ground.
Right.
And then set up the schedule, recorded the receivable, and every single project is followed the agreements. You might have had one that actually paid a little bit ahead of time,
Yeah, they did. They said,
but everybody else, paid exactly according to schedule. So
and this year our very large solar farm. Papers are flying, to close
to close on that.
on that. And, that's another one that
Is
goes,
that three? Are they gonna pay over 3 years?
no, it's like 5 or 6.
5 or 6?
Sure.
1.9 altogether.
Is it really that
We're
much?
we're stretching that out, so.
Great.
And that's close. I mean, it's interesting. I just sent Mark an article yesterday. The price of solar panels has dropped 70%. Wow. So it was interesting. China operates much like the United States with states, but the states are a lot more autonomous. They have their own funding, so they all funded these solar panel plants and they started making them. Because it wasn't enough. It wasn't enough, and all of a sudden, China realizes, wow, can't sell these, so they're just dumping them on the market. It's just 70%. Wow. So we're gonna see a lot of activity here soon, I think, and they're stockpiled not only there, but in the states. States have stockpiles too. Yeah. So,
Interesting.
yeah, 70%, amazing.
So then, continuing on page 25, some good footnotes on your EDA cares and your partnership for economic growth funds. Talk about what you spent so far on both. EDA care, that one, now that it's kind of in the evolving phase, maybe in the next couple of years, that footnote will drop off because we didn't always disclose the L-type like that. But this was the last year you gave out a loan, so we kept that in there. Note 23, sale of Talcott Street, just a large transaction, so that was disclosed, talking about the balances, how much was received, how much was paid, how much you had on your books for the asset. So that's all broken out there. And then 24, the prior period adjustment you asked about. The 56,000 of revenue that could have or should have been deferred. Okay, so then there's a bunch of good supplemental schedules. I won't go over them in detail. The CREDC information is broken out between PEG and CREDC itself. Rich, you're page 27. I've heard back from 3 of them. So I've got JCC Foundation, Jamestown Center City Development, and NRG. So it's the other, and actually,
Yeah, I think Lutheran, that was M&T, right?
I think I may have gotten another one yesterday.
Yeah, I think that we got all the M&Ts. 2 of the M&Ts came from somebody else and the third came from Kevin himself. So I'll make sure I'll forward the emails if I didn't.
Now, the one thing I noticed though, NRG and I think Jamestown Center City Development were paid or refunded.
Yeah, refunded.
So if they're refunded, do they come off your schedule? Because you weren't really a part of that refunding, correct?
Well, I had to sign papers, so
You had to
we're still in it.
So you're
I
still in
think
it?
I have to report the balance.
Okay,
You do?
Yeah, absolutely.
Okay.
And NRG never paid. I mean, that bond has been the same,
yeah, that,
and that's how they operate. They just
Yep.
keep it on the books till they don't mind paying interest, I guess.
okay. All right, so then you want to go to page 32. So we are required to provide you 2 other letters. The first one is government auditing standards, since you're technically a government entity. So we do have this letter. There is one finding that we're reporting on that. It's finding, 2023-01. And then page 34, the uniform guidance, and this is because you're a federal entity or you're receiving federal funds over 750. So we're required to audit your programs, and we looked at your EDA CARES fund. And there's a finding related to that. It's the same finding that's on the government auditing standards. So if you want to go to page 37, we can talk about that. So page 37 then breaks out the finding. So, what that finding is really related to, it's the Weber Knapp loan in the EDA CARES fund. Was for the purchase of stock. So you loaned $1 million for those local individuals to be able to buy the company. There are pretty clear language in the loan that are in the compliance requirements for that grant, that if you do that, one, it's not allowed, but you could get around doing that if it met a couple of stipulations. And those stipulations really need to be documented. And I think that's really what our finding is about, is that, you felt it met one of the stipulations, so it wasn't you approved it like you approved any other loan, really. It may have been discussed in executive session, but it wasn't memorialized in the minutes that we understand that this may be an exception, to the rule.
So did it just need to be in the minutes or did it need to be in the resolution?
Probably both.
Both, I would-
Okay, all right.
So the three justifications are: one, imminent closure of the facility; two would be a significant expansion;
Mhm.
and three was a significant additional jobs, so job growth. And so, one of those three have to be really the rationale for providing the stock ownership.
And while it was in the application, right, that there was good possibility that it would be sold assets and that would have left. We didn't have it in the minutes. And we didn't also put it in the resolution. So we are having Greg Peterson review that resolution and we will amend that next week at the March board meeting. And that'll be the same for the loan that's coming that we just had at the loan committee. The same situation. We know that was going to close. It wasn't.
Right,
sold. So
right.
we will document it in the minutes and we'll also have put a whereas in the resolution for those. Okay.
Okay, so there's a spot for agency response. I think if ultimately we're gonna do the amended and it's gonna happen, I think it's worth putting that right in here,
Yeah,
that
let's
the
do it.
response, you know what I mean? That,
I recall discussing on this Weber Knapp one that, we were afraid it was gonna leave the area.
Yeah.
If it was bought by some, capital company or whatever, so that was our justification. But we could certainly get it in writing and add that in there, that way it's real clean and tidy.
exactly.
So yeah, and that finding, you'll notice it also kind of appears down below as 2302, because, on the government auditing standards, that comes across as a compliance finding. But then and similarly, it's a compliance finding on the single audit. So it's kind of on both schedules, but it's the same finding. Okay, so then we also provided you two other letters. We'll talk about the management letter first, just because Dave kind of talked through it already. But this is the talking about the service contracts. This is the one titled, "We have completed our audit." Top, the one page. So that is the management letter on the service contracts, just making sure you're, following up on those agreements, making sure they're, actually written as service contracts and that, the requirements are being adhered to if they're required by you. I mean, that's ultimately is if you're going to be held responsible for those federal requirements, you need to make sure you are complying. And then the other letter is the governance letter. So this is to the audit committee and management, talking about the audit, whether we had any difficulties, whether there was any issues during the audit. It's a normal clean letter. You have one audit difference that we report to you every year. You guys don't report accrued payroll. So instead of, accruing payroll, this would be when you pay people on July or January, first week of January, it's really December's time. You should have recorded that as a liability. You've never done that. So because of that, it's actually only like a $2,000 difference, because really the real difference to your financials is the change in that accrual, not the whole balance. So it's a minor difference.
We talked about this
Yeah.
a month or two.
And it's interesting. Every 17 years, you'll have 27 pays in a year. Bi-weekly.
Yep.
And I found that out the hard way. I was working at JCC and they gave me a raise and they said, "Oh, by the way, we're dividing it by 27 because there's 27 pays in the year." I said, "What?"
That happened with the county this year.
This year, the same thing?
Something.
Yeah.
Yeah,
There
so
were people going, wait a minute.
Mike
Get more. Something.
Yeah.
Mike Metzger's was livid. So what he said to do, and maybe we should talk about that at some other point, was he said, pay people every 2 weeks. make their letter say your salary will be X every 2 weeks.
Yeah.
Now, the accrual still comes into place,
Right.
Yeah.
but we won't have to divide by 27 because that's what it says. You get-
Yeah, so like our pay at BWB, it's the 15th and 30th. So like that never really comes into play because it's always the 15th and 30th.
Okay.
But like we audit a lot of electric cooperatives and they had that same thing happen. And it was a big stink of, well, what do we do? Cause like, are we gonna go back and ask people? Cause they didn't divide by 27.
Oh.
They forgot to do that. They didn't
Yeah.
realize it was gonna work
On
out that
December
way.
31st, they gotta write another paycheck.
Yeah, they got, so everybody got an extra paycheck and then it was like, well, what do we do? Do we ask for money back from all of our employees? And it happened to all of them.
Oh, yeah.
And, you know, that was a big,
Bonus.
that's what most of them chose to do. It was a
Yeah.
big topic of
Oh, yeah,
discussion.
it would be hard at that point. I mean, it was hard enough to do it in January, let alone doing it in December.
Oh, wow.
Yeah.
I better pay more attention to that then, huh?
Well, nice work. I mean, like.
Thank you.
Yes.
Yeah.
Mhm. Yeah.
It's been a pleasure, Dave. Thank you.
Amazing amount of work on all of you.
You know, Dave and I talked throughout the year too. It's helpful for me to have somebody I can call and
Yeah.
stuff off of
Yep.
and, you know, it's getting more and more complex every day. Thank you, Dave.
You're
Thank you, Justin.
Thank you.
Yeah, one of the items that Rich and I had a little bit of a discussion about that I thought I'd bring up is obviously you had an ABO audit, they had a lot of things. You created a lot of.
Don't remind us.
You created a lot of policies recently.
Yeah.
And then modified some procedures as well. And one of the things that I mentioned to Rich that you could consider, one of the engagements that we could provide is called like an agreed upon procedures agreement where we would kind of like, and it would really be you, it would be outlining, you know, we could work with you, but ultimately you would accept like, here's the procedures that would take place. An example might be, I know one of the items was not to pay credit cards via electronically. And so maybe one of the procedures would be review 3 months of activity and were there any credit cards paid? And then it would just be yes or no, you know, the report would say reviewed, nothing to report. And you could list 10 or 12 procedures and it would just be,
Yeah, you
here's
go
the
right on that
procedure.
audit and go down through what.
You
their
know what I mean?
recommendations are.
Yeah, you know, policy is without procedures, a policy doesn't mean a lot, right? I mean,
Yeah.
you sort of have to have the procedures that follow the policy, and it's something that we've been talking about, you know, with everything else going on, but it, you know, I think that that's a good idea that we, you know, maybe we start with the low hanging fruit, you know, some things
Yeah.
would be real simple, other ones
Yeah.
might be more complex,
Yeah.
but
Well, I think the
That's a
biggest
good
one would be
idea.
the credit card, because that's the thing we changed the most.
yeah.
So are we talking about some form of internal control narratives as well, like
Well, this would be more like,
a higher level?
well, I think this would be more like,
It starts,
here's what you said you're gonna do.
Yeah.
Did you do it?
Oh, I got you.
Another example is like the pass-throughs. There were a couple comments on the pass-throughs. So we would say, this is what we're gonna test and did it happen or didn't it happen? And, you know, whether, obviously, a lot of the policies you just put in place. So, you know, has time passed? Where are you doing it or not? You know, it might be a good time.
It could even be something like, okay, so it would sort of dictate if somebody uses a credit card and buys lunch.
Mhm.
They get their receipt and they do an agenda from that meeting. And then they attach the three together. They give it to Kayla, right? And then
Yeah.
Kayla enters it into the system and then she, you know, waits for the billing statement to come and then checks it against the receipts and then she, you know what I mean, right?
Yeah.
And so it's like a procedure
Yeah.
Yeah.
And
that follows the policy.
yeah, and so what I'm recommending isn't necessarily us developing. the
No, I know.
procedure. It's more testing.
Right.
Right, yeah.
Did you?
Are we following what we?
Are you
said?
following what you?
But we have to have the
said?
procedure in
You gotta have the
place.
procedure in place
Place,
first.
and then you,
Yeah.
then you would test. it,
Yeah.
Yeah, but I think we need to,
And those are those internal.
Yeah, so it's
What do you call
sort
it?
of starts with internal control narratives.
And
That's there.
same
Yeah.
thing.
Yeah.
Same thing.
Well, yeah, I mean, can we pick some three now, Dave, and look at them at the end of the year or in July or June? I mean,
Yeah,
what would be your recommendation on where we started? That would be helpful for us.
well, why don't we
Or Mark, you
look
want?
at the,
Yeah.
the report and
Okay.
again, we can,
Yeah, I
We-
think you picked the couple highest that you think are the highest for
Okay.
highest priority.
Okay,
And I know you'll have that.
yeah.
yeah,
Mark.
yeah.
Want
So we
to
can-
find a new engagement letter and all that too. I'm assuming
Sure.
Yeah,
for that.
that makes sense.
No problem.
I like that.
Okay.
Good.
So we've got a meeting next Tuesday,
Dunkirk.
Dunkirk.
Sorry.
And so I think, again, we'll get the nationwide
Yep.
information, which we need.
Mhm.
You're gonna contact the county to try to get something on the forgiveness.
Yep, I got it down.
And then the response to the finding. Maybe
Yeah, Mark,
we can write something up. You can write something up on that and we can plop that in there for them.
Would it be
Check on it.
appropriate to just say, you know, from going forward? I mean, can we say, well, it was discussed extensively at both the loan committee and in executive session, we will
Yeah.
You're,
document it in the minutes and also have it in the resolution? Does that sound like a good response?
Yeah, I think if,
Amended.
I would even say it. Yeah, I think if it does get amended on the 26th, I would even say that, because
Okay.
this will be
Yeah.
dated the 26th.
Yeah. so we'll say
So I
it was
think-
amended on the 26th to include language about the imminent closure.
We'll do that. That'll be the first
Exactly.
order of business before they do the audit. We'll do it before they actually do the audit. I think that makes sense.
Yeah.
So that'll be on the agenda.
And then we'll,
Resolution number. And it'll be the same resolution number, it won't be a new one.
The one for
So
what
you'll
for
have to
now?
go back.
Yeah.
Yeah, I've sent the draft to Greg. He's
Okay.
reviewing it wherever Greg is. I forget where he went this time. These retired guys, you know, they just travel all over. He was in Costa Rica.
What a
He
big
was
good for him.
he was everywhere. He's got his grandson this week, Odin, just him and Odin.
nice,
Odin's a handful, he says.
Yeah, very
Okay.
nice.
Okay.
Okay.
Go ahead and adjourn.
We all set? Was there any old business to come before the committee? Hearing none, we'll consider the meeting adjourned. Thank you.